My name is Matthew Clements of ESG Investing in the UK, and I'm speaking today with John Guerard, Interim Director of Quantitative Research and Chairman of the Scientific Advisory Board at McKinley Capital Management. McKinley were finalists for Best Specialist Research at the ESG Investing Awards 2022. John, I just wondered whether, first of all, you could just give us a quick overview of the ESG research you do at McKinley.
Yes, certainly. Thank you, Matthew. We've been working on ESG SRI research at McKinley ever since I became Director of Quantitative Research in 2005. What we've always been doing is working on social screening models, making sure that we eliminate those stocks that have environmental concerns, and then we look very seriously at firms that have issues with military, with nuclear power, and the alcohol, gaming, and tobacco stocks, the sin stocks. So we've always been aware of those. And it's the reason that we've always been so interested in SRI, particularly since I joined McKinley in 2005, is that there's an award for the research in SRI, the Moskowitz Prize, which has been given since 1996. I was the recipient of the first Moskowitz Prize in 1996 for my paper, "Is there a cost to being socially responsible in investment?" And the answer was no, obviously. That $1 invested in the Russell 3000, $1 invested in a KLD screened universe would give you the same approximate rate of return over time. So there was no statistically significant difference. And that was my paper then, which had to do with the 1300 stock universe as opposed to the KLD universe of 2800. And so I've continued to work on that. And since I wanted the Moskowitz Prize, the award's been given annually to faculty at Harvard, Stanford, Chicago, Wharton, Erasmus. And the current winner this year was Laura Starks at the University of Texas, with whom I shared an office in graduate school several years ago.
Okay, and thank you, John. Can I just ask you what you consider to be the most important themes in ESG investing at the moment, and how you think that might change in the next sort of 12 to 18 months?
When you look at most surveys of institutional investors, the first question they have is, what is the environmental screen? And that's what Chris Gacy and I have in our paper that we were the finalists for this award with. We were looking at ESG investing and the environmental screens. I think one thing that's important about the environmental screen is not just the overall screen, but also the climate change component of the KLD screen. One thing I think is important, we've always used the KLD database. We've used it through the WRDS services, now the Wharton Research Data Services. Now, KLD is a great database, goes back to 1991, and our work goes back to 1991 for what amounts to now, about 30 years of data on SRI ESG. And so I believe climate change is going to be the coming concern in the next 3 or 4 years for ESG investing. Yes.
Okay, and specifically for ESG ratings, for example, do you consider that there's an inherent problem with ESG ratings? Do you think that's been addressed? And do you think the quality of ratings is improving?
The quality of ratings are improving. I will say this, in my opinion, the KLD database for the US has always been the gold standard. And that's been true since 1996. It continues to be true. The categories are broader now. The subcategories are better. The problem gets to be that the international data is not as well defined as the US database. In other words, if you look at the KLD database and the way it's developed internationally, since it's changed owners, there's not a full set of categories with respect to the criteria, and the data is not as in-depth and probably not as good. But you can clearly run a global portfolio with KLD data and other data. But the data internationally is not as strong as the US data. I think that's a fair statement. And what's really important about that, Matthew, is the fact that as important as SRI ESG investing is in the US, it's even more important in with the European plan sponsors.
Okay, and with respect to funds, ESG related funds, how much of a problem is greenwashing, do you think?
Well, I think it's a huge problem. I think it's a very large problem, primarily because of the fact that, in some sense, many funds can say, well, we are an SRI ESG fund by simply taking one criteria and screening out 5 or 6 stocks from their traditional portfolio based on that. And they're going to say, we are now an ESG SRI investor. And the bottom line is that they're not a true believer. And with a true believer, what I mean by that is, in my humble opinion, you need to look at environmental concerns. You need to look at the sin stocks. You need to look at nuclear power and the gaming, the nuclear power and the military screens before you're truly an SRI ESG investor, in my humble opinion.
In the US, what's the regulatory framework with regards to greenwashing? Is there any sort of pending regulation that's going to come in that's going to be apply stricter rules to funds with regards to greenwashing?
One never knows. One never knows. To be honest with you, I'm not in compliance, and I have no idea what the SEC is going to do with respect to the hearings that they're having on ESG SRI investing. I know this: I would prefer that the market be able to weed out who's really true and who's not, because the data is there, and SRI funds have delivered a higher return than traditional mutual funds for the last 20 years, according to my co-author Chris Gacy in the presentation that we presented at a Wharton Research Conference last year that's under review for an Oxford University Press book. SRI has not cost investors money in terms of mutual funds, and I think that is a huge statement to make.
As regards to funds and also the behavior of listed companies, how do you see the difference between the US and Europe? Do you consider the US is perhaps still a bit behind Europe? And if so, why do you think that is?
When I look at corporate policy, I believe that the corporate policy mentality in the US is vastly different from that of Europe. Europeans tend not to be quite as bottom line oriented as Americans overall. I'd say I don't think that's such a rash statement. Americans certainly go straight to the bottom line. We allow ESG investing when we can take a good stock selection model and do social screens and still have good stock selection left. That's how we believe in SRI ESG investing. I'm not a passive ESG person. I don't want to take a 400 stock index and look at it compared to a 500 stock or a 1,000 stock benchmark. What I want to do is take an active portfolio and screen based on a good stock selection model, and then look at how that portfolio performs relative to a benchmark. I think that's what's important.
Okay, and if you look at the 3 pillars of ESG, do you feel that climate change is beginning to dominate ESG? And do you think it will continue to dominate more ESG? And is there any difference between the US and Europe with regards to that?
Well, I believe that obviously European plan sponsors are going to enforce that long before US plan sponsors enforce climate change criteria. I do believe that. And I think climate change is quite frankly a huge component. And what we showed in our research was, if you have a good stock selection model and you buy stocks that score well on the KLD environmental screen, that's much better than buying poor stocks on a stock selection model and having environmental screen violators. And so I think as long as climate change is important, and I think it will be, I think that the same analysis that we did for the environmental screen should be done for the climate change component of it.
Okay, can I just ask you finally, John, with regards to ESG and institutional investors, is a major impetus for ESG coming from institutional investors, pension funds?
Oh, absolutely.
To what extent is that being supported politically, would you say, at the moment?
Well, one of the great headlines in P&I about 2 or 3 days ago was that 3 New York City pension plans were apportioning about $7 billion of their assets to ESG. And I think that's what's going to drive the entire process, is when more of the pension funds, and many public pension funds in particular, say that we want to have ESG criteria. I think that's huge. We know this. We know that the ESG portion of funds is rising substantially. It should be, because you can do well with ESG. It need not cost you, as I said, with the work of Chris Casey and Rob Stanbaum, that ESG need not cost you anything. We said that years ago. It's still true, and I think that the more that people can use ESG standards and criteria in their stock selection and their mutual fund selection, I think the smarter investors are going to be.
And with regards to the what you've mentioned in terms of the relative the outperformance of ESG funds, do you consider the current inflationary environment as posing any threat to that?
Frankly, no, and for the following reason. I think one thing that's important about mutual funds is that all mutual funds are going to be behaving relatively similarly with respect to their risk premium. And I think the risk premium established by the KLD criteria, where they tend to usually be a little bit more growthy funds than traditional funds. I think those funds will be fine. I don't think high inflation is going to cause any disproportionate impact upon SRI ESG. No, sir, I don't.
Okay, thank you, John.